today is that my hope is that Gene and I can kind of unpack taxes a little bit, unpack the thinking behind taxes, and then I want to actually hit some specific strategies and just kind of talk through what we could and should be doing here in quarter 3 of this year. And then certainly we probably won't have a time for every question, but take some questions at the end. In addition to that, we'll give you a means to get all of your questions answered. So if you have questions that we don't answer, we'll make sure that we provide you some contact information here for us so that you can get in touch and talk to us. Does that sound fair?
I love it. And so if you do have specific questions, guys, try and hold them to the end. We can't get to them throughout, but we'll do our best to get to them at the end if we have time. Yeah. Thanks, Gene and Chris. I'll turn it over to you guys.
Great. Well, everybody, again, I'm Chris Brown, the CEO of TaxHive, and my partner here, Gene Bott, is the CPA extraordinaire who oversees all the work that we do and our team does. And as Kendall mentioned, the idea when we talked with Kendall and Don about what would be of use for all of you today is to really talk through where we sit this year. We're sitting here in quarter 3. I know it's hard to believe, but we're already sitting in quarter 3. And if we're going to impact 2024's taxes, now is the time to do it. We're running short on time and we've got to get things in place now. So our hope tonight is to show you a little bit about what's going on in the tax world, the thinking and the approach that we need to take, coupled with things that we could and should be doing potentially right now to impact that bill that's coming due next year and set you all on your way. I think the idea is Gene and I are going to kind of tag team this a little bit. And so, Gene, feel free to certainly cut me off at any point. I'll probably hit a couple of these first slides and then really going to lean into Gene as we get into some specific strategies. But, Gene, feel free at any point to give your 2 cents. Your 2 cents is worth more than most. So please chime in. But I think it's important just to understand a little bit about the tax code. The tax code is really written to incentivize a specific set of behavior. The government, this isn't a left or a right issue. I know we've got elections and all sorts of other crazy things going on right now. This really has nothing to do with what side of the political aisle you're on. Those that write the tax code know 2 things. These are actual statistics from the government, that 2/3 of all new jobs in this country are created by small businesses, and that 40% of economic activity in this country is generated from that same group. And so what do? They want to drive and fuel the economy in their own local area, nationally, in their state. So the code is written to incentivize behavior. So when we open up a business, when we begin an activity with an intent to profit, all of a sudden, the opportunity to save money through tax savings opens wide up. And the government is begging and pleading with you and I to be a small business because they believe we can contribute in a real meaningful way. So I think the first place to start here is, even if maybe today you aren't a business owner, if you don't own a business, I think my recommendation would be go find that side hustle, go do something. For those of you that were on as we were starting, my very first business was a network marketing company. And while I didn't make much money in that, the opportunity to save in taxes was tremendous. My wife ran a little side business selling shirts, and again, didn't make a ton of money, but that opportunity that opened up in the tax code led to other things and other businesses. And I think all of us living in this remarkable country we live in, there are ways to have some kind of side hustle to take advantage of the code. Now, on the other side of the tax code sits the IRS. And what are they? They're the biggest, baddest debt collection agency there is. They know how to get at your money. And if you owe them, they have ways to get the money. Now, this might sound really strange to everybody on here, and Gene, certainly chime in on this if you want, but the IRS, I don't think, is our enemy. I don't see the IRS as an oppositional force in all of this, because what they've done is they've given us their playbook. We know what the rules are. Gene and our team here at TaxHive, they know the rules. And so imagine if your opponent gave you their playbook and let you know what plays they were going to run. Well, all of a sudden you have a tremendous advantage. And there's enough opportunity inside of the rule book that we don't need to step out of the rule book. We don't need to do dumb things. We don't need to put ourselves at risk. We just simply need to understand the rule book and then play by the rules. Because as Gene will attest, the rules are provide plenty of room to save thousands, tens of thousands, even potentially hundreds of thousands of dollars in taxes. So let's not see the IRS as the opposition.
Can I make
Please.
a little plug here as well? Just in case any of you are in this situation, I would hope you're not, and working with Protect Wealthy, you probably are not. But to that point, with the IRS not being your enemy, you should know that filing your taxes, if you have past due taxes, is something you really need to get done because they really aren't your enemy. If you're trying to work with the IRS, they will work with you in one way or another. They will work with you. If you're avoiding them, that's when it becomes a problem.
Yeah. Amen. And unfortunately, we run into that every day, right? We talk to
do.
people that are calling that haven't filed taxes in 4 years, and that's about the worst thing you can do. So get them filed. I want to ask the question, and I won't make you all answer it, but I just want you to ask for yourself, do you believe that you're maximizing your tax deductions? Just think on that question for a minute. Do you believe that you are maximizing your tax return and taking advantage of everything that the tax code has to offer? Well, we run a lot of marketing online, and we've surveyed thousands of business owners. In fact, over 30,000 business owners surveyed, and 75% of them tell us that they're not confident that they're maximizing their return. So 25% feel really good, but 3/4 of business owners that we've surveyed say, man, I know I'm paying more than I should, and I want to fix it. And so I want to share a little kind of story to preface up these examples that we're going to give today. And I want to talk about tax planning versus tax prep. So again, let's equate tax preparation to a carousel. We are all on the carousel of tax preparation, whether we're a W-2 employee, whether we own our own company, collecting Social Security, whatever it is, we are all paying taxes and we're on this carousel. And again, the numbers tell us that 75% of the people on this carousel think that they are not taking advantage of the tax code. So if we imagine their tax preparer as one of the horses on this carousel, they're on this carousel and they believe that they're on the wrong horse. 75% of people think they're on the wrong horse. So what do we see them do? We see them get off that horse and say, man, this horse stinks. I need to go find another horse. And they get on another horse on the tax preparation carousel. And they have the same experience. They say, man, I feel like I'm overpaying. And so they get on another horse, and it becomes this real frustrating experience. And I want to propose tonight that we have to have a little bit of a mindset shift. We actually have to get off of the tax preparation carousel altogether to save money. Because there's another carousel sitting right by it that's the tax planning carousel. And we need a horse on each carousel. We need someone to prepare, but we need someone to plan. And if all we do is stay on the tax prep carousel, we're going to be incredibly frustrated. Tax planning and tax preparation might look very similar. The disciplines might look like baseball and cricket. They both have a bat, they both have a ball. Gene, I think, your wife, I think, plays a little bit of pickleball
Yep.
and tennis, right? They look similar, but they're very different disciplines. And if we expect tax preparers to do a great job helping us save money on taxes, that's like asking a fish to climb a tree. It's just not going to happen. So we actually have to recognize that these are two very distinct disciplines. Preparation does not save us money. Never has, never will. Because it's the activity that we're doing right now today that's going to impact the information that we give to the tax preparer. And we have to change the data now. That's where planning comes into play, so that when we go to prepare our taxes, we have a different set of data that we can give to the tax preparer to impact our taxes differently. Gene, anything you'd weigh in and say there before I explain why this matters so much?
Yeah, I think what I would add there is they're enough different that very few tax professionals can actually even play in both worlds. It's amazing to me when you really break down and you look at the tax planning communities, tax planning businesses, those that are actually doing tax planning out there. A lot of them are doing tax planning and tax preparation both, but you'll find that they have a tax planning team and they have a tax preparation team because they're so different, and it's impossible to know enough about both of them to keep up to date.
Great point.
Not
In fact,
impossible, but very hard.
Well, in fact, that's how we do it here at TaxHive, right? I would consider Gene an expert in both, but the people that are kind of a unicorn. And so at TaxHive, while Gene oversees and works with everybody, we actually have two completely separate divisions, a preparation division and an advisory division, because finding the Gene Bots of the world, those unicorns are too hard to find. Now, why does this matter? I want to share this with you because I think this is really what I hope will inspire all of you to take a look at where you're at and take control of the situation. I wanted to know how we were doing. I wanted to know what impact we were really having on clients. So I went back and I had our team audit over 2,000 tax plans over the last couple of years. And here's what we found. If you look at the revenue number there on the bottom, that tells us what was the revenue a business was doing. And then that yellow number shows us how much we were able to identify in potential tax savings. So a person that was doing less than $100,000 a year in revenue, we were identifying, even for them, on average, $15,000 in potential savings. Somebody doing 350 to 700,000 a year, we were identifying $42,000 in potential savings. Somebody doing over 3 million a year in revenue, over $200,000, not in deductions, in real tax savings. Those are dollars to the bottom line. And so I want you to ask yourself, right, on this scale, what would an extra 15 or 40 or $140,000 mean to each of you? What would you do differently? Certainly Kendall and Don have all sorts of ideas that they can show you to help you come up with ideas on what to do with that money. But man, these dollars really matter. And these aren't 1 year, or these aren't just one time, they're year over year over year. So these tax plans that we identify usually equate to these kinds of savings over each year over years. So 10 years, we're talking 150 or $2 million in tax savings. Like, this is real money. These are real dollars that you've worked your tail off for. And so now what we're saying is, let's take advantage of that hard work and keep those dollars in your pocket. The government's incentivizing you to do it. And we believe that you have the capacity to do more with that money than the government did. So where do we start? Gene, I don't know if you want to maybe just quickly unpack 30 seconds on each one of these, but this is kind of our basic structure for where we go to look for tax savings. We call them our 4 pillars, and we look in each one of these when we work with a client to identify areas to reduce taxes.
Yeah, one of the interesting things to note here as you're looking at this is pillar 1 and 2 can almost be done hand in hand, and they often are, but pillars 3 and 4 are next steps. So most of you, when you're starting out here, you're going to start in this pillar 1, pillar 2. Pillar 2 might be one you're using entirely if you're in a situation where you don't have that side hustle we talked about, but again, we recommend you get into it. So pillar 2 there can be used even without pillar 1, but pillar 3 and pillar 4, if you're using those and you haven't looked at pillar 1 and pillar 2, you're probably missing some stuff. Now, pillar 1, we're talking about you're coming in here and you're looking at how can I take advantage of what I'm already doing and get better tax benefits from that. Pillar 2 is really looking at how can I shift how I'm claiming what I'm doing to get a more advanced savings from it. So that's how they're really hand in hand there. Is it's just pillar 1, you're making sure everything's reported. Pillar 2, you're making sure it's reported in a way that gets you the best of both worlds. Pillar 3 here, we're coming in and we're talking about tax gaps. This is where we actually use the code against itself. There are holes in the tax code, legal tax holes, where you can actually come in here and say, well, this section of the code says this, and this section of code says this, and because of that, we're able to do this in the middle that fits. And these are time-tested, approved things. This would be stuff like using your home as a rental for your business to take advantage of what we like to call the Augusta rule. And we'll probably cover that in more detail later. But that's what we're talking about here in these tax gaps, where the code allows for some discretionary decisions on ways to do things better. Pillar 4 is the one that really is the heavy hitter. When you're ready to start implementing this pillar 4, this is where we make huge differences. It does typically require that what you're willing to do is shift the way you use your money, not necessarily always giving it up. There are some strategies where you use money to make purchases to get larger tax benefits out of those purchases. And then there are ways to use that money to buy investments that give you better strategic advantages. And that's what we're talking about when we're talking about dynasty strategies here.
And when you look at this, again, coming back to maybe a little bit of our pre-meeting conversation that we had, when you wonder, well, how are Elon Musk and Warren Buffett paying so little in taxes? It's because they're really getting into pillar 3 and pillar 4 type strategies. And what I would say is, even if we aren't making Warren Buffett or Elon Musk money, which most of us aren't, the same principles apply. And they just apply on a lot smaller scale. And maybe not every single strategy, but there's things that fit inside of those buckets. And the difference is they plan and they execute on a plan. They don't just show up at tax time with their documents and hope that the Gene Bots of the world can save them money. They've strategically implemented things throughout the year. So now what we want to do is I actually want to spend some time unpacking some specific strategies. We're going to look at some blocking and tackling type strategies, and we'll get into some more sophisticated strategies. But this first one is one that I want to talk about. It's kind of a pillar 1 strategy. Basic blocking and tackling is the home office deduction. And I think pre-COVID, we kind of had this idea about who could qualify for this. Now, Gene, I would say post-COVID, almost everybody is doing business on Zoom or at home or in different ways. So why don't you just help us unpack, Gene, basically the 2 ways to take the home office deduction and why you think one's better than the other?
Yeah, before we dig in on that, let me hit really quickly. There may be some of you on this call that still live in fear of this home office deduction. Please don't. I know way back in the 80s, these were heavily hunted strategies, and for some reason, there is still this lingering fear of the home office deduction because of the fact it was hunted way back in the day. They're not hunted, but even if they are, if you're claiming this right, the IRS cannot prevent you from claiming it. It was hunted because it was not used correctly. So just use it right. Now, as far as using it goes, there are 2 methods. There's the simplified method and the actual method. The simplified method, all you're doing is you're evaluating how much square footage in my home am I using for home office space. Take that square footage, multiply it by $5, and take a deduction for that amount all the way up to $1,500 per year. The regular method, you're actually going to come in and you're going to figure out how much is the square footage of my home office relative to the home. So let's say that you have 100 square feet in the home of a 1,000 square foot home. You'll now have a 10% deduction. Now you'll go through and you'll figure out, well, what are my expenses for the home that are qualifying expenses? And I'll give you a hint, it's just about everything. And then you're going to take 10% of all of those expenses and you're going to claim them as a home office deduction. And remember, that's just about everything. So it's pretty good.
A couple things I might mention here. You don't want to rent your home from yourself. And we get hit up with this all the time. And the reason is if you rent the home, the business has created an expense, but now you're creating income over on the personal side. So this home office deduction is the way to do this. Now, the reason that this matters is using the regular methodology. We had a client. When we look at this, Sarah had a real estate business with an income of $92,000 a year. She had a 9% of her home was office. And so she was able to take 1% of real estate taxes, mortgage, interest, utilities, so on and so forth. And the real number that this created was a deduction of nearly $6,300. That's way better than the simplified $1,500. Again, over 10 years, that's $62,000 in tax-free income. It's one of those things that it's just a little bit of energy up front produces a massive savings long term, and once in place can happen year over year over year. Now, Gene, the home office always leads us into the Augusta rule, or Rule 288.
Yeah, but before we dig in there, if you don't mind, I'd love to throw in a little bonus on that last one. One of the other great things about the home office, most of you probably know this, your commuting miles from your house to your work, it's not tax deductible. But once you add in that home office, you're commuting it from your home to your work is actually you just getting up and going to that home office. And then your drive from your home office to your business is actually business mileage, and you can claim that as a deduction. So it's pretty fantastic.
Yeah. So now the Augusta rule 280A. Gene will tell me to call it Rule 280A. The IRS likes Rule 280A better than the Augusta rule. But Rule 280A basically tells us that I can rent my home, but I don't have to claim the income. Now, there's some rules around this. I can only do it up to 14 days per year.
And that's
Like,
for any type of rental.
yeah. So 14 days per year. So I can't rent my home out for 15 days. Now all of a sudden all of the income becomes taxable. Now, if you're anything like me, your wife and your kids probably don't want to rent out your home 14 days a year on VRBO. So what you can do is you can actually rent this to your business. So my business can rent my home for specific business purposes, and my business can pay me for the usage of my home, and I don't have to claim the income, but the business gets to claim the expense. Now, Gene, I want to have you walk us through kind of a real life example to show people how this works. We oftentimes lose people on this last rule that it's got to be in line with going market rates, and people think, well, man, my home on VRBO wouldn't rent out for much, but you're going to explain to us these aren't VRBO rates. So why don't you walk us through Chris's example here, Gene, and help us understand how we can really take massive advantage of the Augusta rule. And I do want to point out, you can use the Augusta rule and the home office deduction when you do this the right way. So Gene, help us unpack Chris's situation here and walk us through so we can kind of make some sense of this in our head.
Yeah, and that distinction that you can use them both is important because there's a lot of content online saying otherwise. But please note, the home office deduction is not a rent, so you can't use them both. Now, how this worked for Chris, we go in and we evaluate where he is at, and we look for boardrooms, not for your short-term rental rates there. So a short-term rental rate is probably going to get you $150 to $250 per night. But if you go in and you're evaluating boardrooms, meeting spaces, wedding venues, if you need to, you can usually find those at a $200 an hour rate. And then if you can get that to a full day, you'll get $1,600. Now that's a good middle ground that we found. Peerspace.com here is a place that we love to go evaluate this because almost every state has something on peerspace.com. Now, if you're in states like Alaska and a couple other states, you'll have a problem. Vermont can be one, but it's close enough to some other states. We can pull in some rates from there. But if you do find you can't get the rates off of peerspace.com, you can just go pull some venues in your area, like what would a wedding venue cost. And you'll find that they also, generally speaking, have a minimum rental period of 4 to 8 hours, one or the other. And so that gives you a good solid half day or full day rental. And then if you need to get that up above the 4, you can just run a 5-hour meeting and you're there. There's great stuff you can get from there. And then what happens is you come in and you say, well, if I can do the $200 per hour and I can do 8 hours a day, that's a $1,600 deduction over 12 meetings, works out to this roughly $19,200 exactly. Roughly and exactly. You can claim that as a deduction in the business. The business now gets to write off $19,200. It pays it to you, and then you don't report that as income on your tax return because it is non-reportable income and non-taxable. Fantastic strategy. And we've used these in S corporations, C corporations, partnerships, sole proprietorships. Now, the one area we're nervous is if you just have a sole proprietorship that does not have an LLC structure. There is actually a a court case out there where the IRS, the judge in the matter specified that one of the things they considered was that it was a single member LLC and not a sole proprietorship, and therefore it qualified for the Augusta rule. Now, that's not to say you can't use this in a sole proprietorship, but you should know if you do and you don't have that LLC structure in place, you have that one court case and only that one court case that may at some point in time be used against you. But all other structures, you can use this. Just make sure you use the right type of meeting. Do not hold a board meeting in a single member LLC filing as a sole proprietorship. Anything to add, Chris?
They don't have boards, right?
They don't have boards, so don't do it.
I think that's the key thing here. To make this work, you've got to be able to hold a real meeting. We're not telling you can fake a meeting. You've got to hold a real meeting. And so even if I'm a single member LLC, I could hold a meeting with a marketing expert in my home, right? I could have a financial review meeting in my home. I wouldn't hold a meeting that is just kind of an everyday run-of-the-mill meeting that I'm holding every week. I wouldn't use it like that. But I think of meetings a marketing review meeting once a month, a financial review? Is there kind of a state of the union that you hold once a month and you bring a person or two in to meet? Those would all be very valid meetings. Make sure you document them, make sure you keep it. And again, this one strategy, when done right, over 10 years is $192,000 of tax-free income. Like, who wouldn't want that? Now, you're going to notice that Gene recommended 12 days here, and we told you that you can do up to 14 a year. The reason that we typically recommend one a month is because it keeps you under that 14-day threshold. And this 14 days is not per calendar year, it's per any 12-month cycle. So that one a month ensures that we don't ever accidentally slip over to 15 and disallow this entire deduction. So you can do 14, but you got to make sure in any 12-month cycle, no matter how the IRS measures it, that you're never over 14 days in a 12-month cycle there.
There is a second hidden reason as well, and that is when you're doing 12 meetings but have the option to do 14, it makes you a little less attractive to the IRS for a fight because they can see that you're not trying to be as absolutely aggressive as you possibly can. It kind of sets a tone for your being reasonable and fair.
Yeah. All right, now let's unpack this next one. This is one of my favorites, Gene's. I want to hire my kids. Walk us through how this works.
Oh, I love this strategy. It's used a lot, and we talked about how expensive kids are, and this one is a great way to help mitigate some of those costs. Put your children to work and teach them some work ethics while you're at it. So hiring your kids is actually done a lot in the wrong way. And that is actually super important that you don't do that. What you need to understand first and foremost is this only works if your children are working. If you don't have them working, you cannot claim this deduction. So make sure you're putting them to work in your business. Second, make sure you are having them paid a reasonable rate for the work they're doing. So don't come in and pay them $1,000 a month to have them come in for an hour and shred documents in your office. It's not going to work. So make sure that you're paying them what you would pay them on the market. Now, one thing you can do is evaluate, hey, what's the political environment in my state? Is there this push for a higher minimum wage than what is currently there? And does that justify me paying them more? And you can use politics to your advantage. But make sure you're fair in the way that you're approaching all this as well. Now, the next thing you need to do, so you've got them working, you've got them being paid a reasonable rate, you now want to evaluate that you're paying them from the right entity. And what I mean there is if the child is working for you and the child is under the age of 17, then that child is actually tax exempt from payroll taxes. So having them work for you is great, but if you have an S corporation or a C corporation, which we often talk about doing S corporate structures, then if they're working for that business, they're not working for you. So now you want to come in here, you want to set up a side business, a single member LLC, have it working for your S corporation, and that is the business where they work. So they're still working for you and getting that deduction. And then you want to make sure that you have it set up so that their payment is going into a bank account that is set up for them. And if it's doing that, you've now crossed all the thresholds and you're doing this the right way. I almost forgot to hit it. If the child is over 17, you really want to have them focused on doing the independent contractor so that they can use their own tax strategies to mitigate the tax liability as well.
Yeah. And then we always get asked, well, what can the money be used for? I'm going to say just about anything. I don't want to say anything, right? But your kids can pay for their own sports, their own dance, buy their own school clothes. They could invest that money. Ideas on what my kids could be doing. They could clean the office, wash cars, do data entry. They could go door to door placing flyers on it. My wife's a ballet director. Even little kids can be used in modeling opportunities for the studio. There's all sorts of things. I wouldn't have my 3-year-old, doing data entry, but my 3-year-old could be a model for the dance studio. And so just get creative and think about this one because it is a great, great, great strategy if you have kids like Gene and I do. Now, Gene, go ahead.
Let me throw out one clarification. When we say just about anything, let's clarify. We mean just about anything so long as it's an expense specific to that child. Don't pay for shared family expenses with it.
Yeah. So the S election, we've thrown out the S Corp a bit. I think it's important to recognize first and foremost that LLCs aren't an actual tax designation. An LLC is taxed as a single member LLC, a multi-member LLC, or we can choose to have it taxed as a corporate structure. S Corp, there's an occasional need for a C Corp. And again, that's a whole other kind of separate conversation that we might want to have with you individually if you think you fit that mold. But we want to talk S Corp tonight because it's the most frequent benefit comes from an S Corp election. So Gene, walk us through, if I have a business, when should I consider taking that S election, and why do I want to take the S election?
Yeah, so the S election, one of the great things about this strategy is that it allows you to kind of split your income from the business into two, those that are subject to the payroll or self-employment taxes and those that are not. And so it eliminates self-employment, but moves it to payroll tax. But that payroll tax is only on the amount that is your reasonable compensation. And you want to keep that as low as possible. In most cases, there are rare exceptions where you actually want to shoot for a little higher. But most of the time, you really want to keep your reasonable comp low. And that allows you to save that 15.3% on payroll tax. And how you do, what was your other question, Chris? The other part of that?
I think that was the big one, actually. You hit them both. But a couple things we need to know, Gene. Gene had mentioned reasonable compensation. So reasonable compensation is always an interesting thing that we get hit up on. I want to put a tool out there, rcreports.com. That stands for reasonablecompensationreports.com. They actually do a great job helping you build justification for what your compensation is. It does cost a little bit of money. Tax side doesn't get paid. We don't have any vested interest. It's just a great resource for those of you that are S Corps to justify the compensation that you're giving yourself. Make sure you put yourself on payroll, pay yourself a reasonable comp, and make sure that you realize that you've got to file 2 returns. Now, Gene, one other thing that I think might be useful for you to hit is this Form 2553. So many people aren't an S Corp and they know they need to take it. They didn't take it in open enrollment. So here we are, I'm September. I made more than $30,000, but man, I haven't taken the S election. What do I do?
Yeah, great question. So you need to understand that that end of the election form 250 or 2553 is due 2.5 months after the date you are going to be treated as an S corporation. So how it's going to work, if you file that today and you don't take a late end of the election, the IRS is going to assume you want it to be effective as of January 1st, 2025. And that's when it's going to kick in and go. But if you actually wanted to do that today and not make the late end of the election, but you want it sooner than January 1st, 2025, you can still file that and notify the IRS your intent is to start as that S corporation up to 2.5 months prior to today. If you want to be effective from the 1st of this year, January 1st, 2024, you have to file that late end of the election, which means you fill out section I of that form, right at the top of it, filed pursuant to Rev Proc 2013-30, and you explain to the IRS why you're late. And if you can get them to justify that reason, and 99.9% of the time, if you have reasonable cause, you can, then you can actually be effective for the pass. And you can go all the way back to 3 years, so long as your tax return for those years has not been filed and you've been trying to operate as an S Corp during that time.
So this is a great one. Right now, we talk Q3. If I'm making more than 30 grand and I'm not an S Corp, it is a great thing to do now. Do that late election for the year, get yourself on payroll. And our advice is generally going to be, if you haven't been on payroll yet, start now and move forward doing it the right way. Don't try to figure out the whole year, but start now and do it now. Again, why does this matter? Austin from Texas had a gross income of about $100,000 after deductions, everything else, made $48,469. If done on a Schedule C, there would have been $7,400 in self-employment tax. Because of the S election, it was only $1,530. A net savings, not deduction here, real tax savings of nearly $6,000 on only $48,000 of taxable income. You know, you look at that, Gene. I mean, that's a pretty good return. That's like a 10% savings off of that net income there for Austin. This can have a big impact on you on where you sit. And remember, you do have to file 2 filings and you've got to put yourself on payroll. Now, Gene, I want to unpack a couple more advanced strategies here to end the evening, if that's okay. I want to talk about partnership deductions. These are usually for accredited investors. This is a tool that allows me to get a large tax write-off while investing. So taking dollars that would be going to the IRS in the form of taxes and investing it over into some type of revenue generating investment or investment that I hope is going to work for us. Oftentimes we hear this being used in oil and gas, so that's the example we'll use here. But help us understand, why might I want to go invest in oil and gas, and what would be the tax implication of that? How does that help me at the end of the year come tax time?
Yeah, and just so you know, everyone out there are some other ways to do this as well. Oil and gas is just one of the more common. But we're often looking at these kind of strategies when you've exceeded other forms of investment like retirement accounts, and you still have more money you want to invest, or you have a tax bill you want to reduce and you've got some money you can play with. And what these allow you to do, let's talk oil and gas as a specific one. It allows you to come in and buy into an investment that will give you a large tax savings today through accelerated depreciation rules. And then with a lot of the providers we're working with, what they'll actually do is they'll buy you out over the next 10 years. And because of that buyout, what you're doing is you're coming in, you're buying shares of a partnership and then deducting your proportionate share of all those expenses. And then they're buying back your partnership. And you're often shifting your income from an ordinary income into a capital gains rate because you're now having them buy back an asset that you own rather than paying you wages for work you're doing or the equivalent thereof. So it's a fantastic way to get a massive write-off today, coupled with changing the tax impact of the money that you put into it. You also have the option of possibly getting into these investments where it's like you hold this for the long term and you just get money that's paying out to you as it makes money.
I think there's a couple of things. I know Gene said it, but I just want to highlight it and make sure you heard it. Think about this kind of as a qualified retirement plan benefit. If we invest the money and we get to write that off, and maybe we don't get to write it off dollar for dollar like we do in a qualified retirement plan, but I'm able to write off 60, 70, or 80% of that. So I make a $100,000 investment and I get a 60, 70, or $80,000 deduction right off the bat. That's huge. That's massively shifting dollars from the IRS to myself. But then the second thing, if you heard what Gene said, is then the income derived from that investment is taxed at passive income rates, which typically are,
If done right.
if done right, significantly lower rates than your active income. So not only do we get a big win in the deduction, but now when I do pay taxes on that income, I'm paying at a much lower rate. It's kind of a double whammy. I think that the simplest way to put this is it's a lot of the benefits of a qualified retirement plan without a lot of the restrictions. Now, Gene, this last one is one of my favorites. Perhaps the reason it's one of my favorites is because it's just sheer math. This is just sheer math. If the math works, I should do this. And we call this an accelerated donation strategy. I'd love you to walk us through this one. And then I've got kind of some examples to show you exactly how the money flows.
Yeah, we'll head it off here right now. We often get from this one, wow, why would the IRS do this? And I can tell you there are reasons that it's actually Congress. There are reasons they have done this. They went to shut it down a while ago and they're like, wait, whoa, whoa, we're losing the benefits we wanted by doing this. Let's put this back in place. So this is actually a very effective strategy for the government as well. There are reasons they want it in place, trust me. So what happens here is they have it set up so that you can come in and make an investment into an asset and then donate that asset to charities and get a massive write-off. And there are some rules that you have to do. It's very, very strict. You have to follow the guidelines. But if you're working with the right partners, they're following these rules, crossing all the T's and dotting all the I's for you so that it's really easy for you to take advantage of this. It just requires your willingness to front the cash. But that cash will often be the case is you put the money in and you get a write-off for 4 to 6 times the money that you put in by making sure all that work is done to cross those T's and dot those I's to do what the members of Congress wanted you to do to be able to get this benefit. So there are reasons they want it. As long as you're willing to have it done the right way, you get that massive write-off.
So let me show you how this works just in practice. Let's just hypothetically say I have $100,000 tax bill. If I didn't use this strategy, I'd be paying $100,000 to the IRS. What we're saying is take 50,000 of that and through this strategy, donate it to a nonprofit. Not your typical way of donating, but through this strategy, donate it to a nonprofit. When you donate that, the government gives you a bonus. And now instead of getting a $200 or a $50,000 deduction, they give that a 4 to 6 times multiplier. And now you have a $250,000 deduction. So think about this. I was already paying 100 grand to the IRS. That was going to happen. But now instead, I'm going to take $50,000. I'm going to make a donation and I'm going to get a $250,000 tax deduction. So I donated 50 grand. The deduction now is 250,000. If I'm at a 32% tax bracket, that's an $80,000 tax savings. So a net savings of $30,000. To break it down one more step. Now in this scenario, $20,000 was paid to the IRS. Remember, an $80,000 tax savings. $50,000 was paid to the nonprofit. So I still paid out $70,000, even though it wasn't all to the government. But that difference, that delta of $30,000, where did it go? That now stayed in my pocket. So when you talk about donating $50,000, we're not saying donate $50,000 and come out behind. You actually come out ahead. This is simple math. If I were to donate 50,000 but save 80, that $30,000 delta stays right in my business bank account or my personal account, wherever it is. And all of a sudden, this strategy has netted me a $30,000 savings in this scenario. Now, typically, this is something that we look at when people are higher income earners because there are rules around what percent of your income you can deduct in this, as well as there's some minimum requirements for most of these investments for the companies that facilitate these. But this is a remarkable strategy for those of you that are higher income earners. This can significantly impact taxes in a real powerful way. Anything you'd add about that one, Gene?
The only thing is this doesn't take into account the state benefit as well. Be aware this can affect most of your states.
Yeah. There's even more potential savings here, I think, is what Gene's letting us know. So,
Yep.
So here we are, again, Gene and I's goal was to kind of frame up how taxation works and give us some ideas going into this fourth quarter of the year, things that we need to be doing now. As you noticed, most of these things aren't things we can wait till after January. They're things we have to be doing now to save. And so I want to answer some questions for you. But before we do that, with our relationship with Protect Wealth, here's the invitation to all of you. I've got a lot of thumbs up and a lot of hearts. That's great. At the end of the day, though, we really want to offer a free consultation to talk through where you're at and talk through what needs to be done to actually help you personally save money. So our invitation tonight is to simply go to protectwealth.com/taxhive or scan this QR code on your phone. It'll take you right there and schedule a free consultation with a member of our team. Member of our team will talk to you about where you're at, get into the weeds to you much more than we can in this kind of a scenario, and talk through with you what really reducing and saving money in your specific situation would or would not look like. So we've shared a lot of 30,000 foot view, but we've only touched the tip of the iceberg here. I don't know what the actual number is, but there are hundreds, if not thousands, of ways to reduce your tax liability, and we've highlighted a handful of them. What is going to work for you in your situation is unique because of all the circumstances surrounding you. So we just want to say, let's sit down. We really truly believe that dollars in your hands do a lot more good for this country than dollars in the government's hands. Not that they're not going to get paid something. But man, again, coming back to our initial slide of dollars saved, $15, $40, $140,000. I would rather see you with that money because I think you'll do more good to spur the economy than the IRS will. So let's sit down and have a conversation. It's a no-cost conversation. We're not going to charge you hundreds of dollars an hour to talk to you. Let's just have a conversation about where you're at and talk through what strategic tax planning looks like for you and what needs to be done to really impact your tax bill and save you money. Again, right now is the time to get this done. I know this might seem foreign, the approach here, to so many, but I want to kind of end where we began. It's kind of hard to believe that we're already into quarter three. It's already into September. When we work with a client at this point, to be able to actually effectively build out a plan, to understand your situation the way that we need to, it's going to take 3 or 4 weeks. So if we go work today and put a plan together, we're looking at getting a plan delivered end of September, beginning of October. When you think about that, that leaves us 3 months to actually get these things implemented and in place. And again, remember, we have to do these things now. We can't wait until the game's over on January 1st. Most of these anyways. So right now is the time. In fact, we really should have done this 6 months ago. But if we didn't, now's better than November or December because we need time to put these strategies into place. So go to taxhive.com, or sorry, go to protectwealth.com/taxhive, or scan the QR code. You're going to get some discounts because you're connected to Protect Wealth. We're going to do some different things because you're connected to Protect Wealth. Go schedule that free consultation with our team and let us help you out. Gene, do you have time for just a few questions?
Absolutely.
Great. If I'm paying my kids, do they need to be paid via W-2, or do we just simply transfer money? What does the actual logistics of that look like?
Yeah, you definitely have to issue them a W-2 at the end of the year if they're on payroll. Now, for children under the age of 17, put them on a payroll. For children over the age of 17, I'd prefer you work it out so that you can do a 1099 and issue the 1099 instead of the W-2.
Great. I want to come back. I just saw this question. So when I'm using Rule 280A, do I have to issue a 1099 miscellaneous to myself and zero out that amount on the business that the business paid me as income? So I think what they're saying is, how do I report this? Am I needing to issue a 1099 to myself? What do I need to do there?
This is one of the areas where the tax code's slightly in conflict. Section of the tax code does require businesses to issue 1099s for items like this, but also at the same time, this section of the tax code specifies it's non-reportable and non-taxable. So it's kind of in conflict. There are ways to work around it if you want to report it, but also at the same time, you can choose to ignore it, and just know that there's a little more risk if you choose to go that way.
Right. A question about filing for my kids. If my kids are under 17 and I pay them this $14,600, do they still need to file taxes?
As long as they are under the standard deduction of $14,600, no, but you do have the option of paying them more, and then they would.
Another question related to kids on payroll. My kids are 5 and 9. How many hours should they be on the payroll weekly? I'll let you hit that, Gene. I think it's going to depend on what the work is that you're having them do. The key thing is making sure
100%.
that you have them do real work.
Yeah, it's 100% dependent upon what you have them doing and how much they're willing to do it.
This is a great question. I have multiple businesses and an LLC. Can each one use the Augusta rule? So I want to talk about this. I want you just to unpack for us, Gene. The Augusta rule doesn't really have much to do with how many businesses I have. What are the rules per home, per property? Because this is a per property rule.
Yeah, remember you have to stay 14 days or less in rental for the property for the income to be non-taxable. And it doesn't matter what that rental purpose is, anything that you rent that home for counts towards that day mark. So if you go over the 14, all the income's immediately taxable. So you can do this for multiple businesses so long as you stay below that 14 days per property. Now, what that means is you could split those 14 days across the businesses, or you can use different properties for that. Just remember, there is also a rule about you basically have to have lived in it 10 times more than the number of days you rent it. And yeah.
I got the question, what time zone is shown when you go to schedule? The way that it works is our tech actually picks up where your IP address is. So it should be your time zone. Unless you're bouncing your IP address through somewhere, it's your time zone that shows up when you go to schedule. So again, protectwealth.com/taxhive. Hope that gives you your answer there, Kathleen. This is coming back to the home office deduction and the Augusta rule. They just want clarification. So I can use the home office and the Augusta rule together, or is there an issue with that, Gene?
You can use them together. If you use the home office deduction and instead choose to do a rent instead of that, you have a problem. But as long as you're doing it as a deduction, and then of course doing the rental of the Augusta rule, you're fine.
And I just noticed Kendall was kind enough to put the link in the chat. Good thinking, Kendall. So if any of you have a hard time getting there, just open up the chat and there's a link right there, a direct link that Kendall put in that you can just click on and get right over to schedule that consultation. Gene, for Rika, and I butchered your name, I apologize, says, how does the home office work if I have multiple businesses in different working spaces? So I think in my head, I'm seeing I've got 2 different rooms for 2 different businesses. Is that allowed, or am I going to get in trouble there?
Yeah, it's a great question. You can use the home office deduction in each and every business, but you need to make sure you're not double dipping on that home office deduction, meaning don't claim one space in each business unless you're splitting that cost across all those businesses proportionally. But if you have one space you're using here for this business, claim it for that business, and then this space over here is for a different business, this other space, then you claim that one as well, if that made sense.
One question that I saw it, but I just missed. I don't know where it is, so I can't find it again. But I want to just say, you remember with the Augusta rule, Rule 280A, that's 14 days total that house is rented out, meaning I can't run it as a short-term rental and then use 14 days of my own. It's total days regardless of who rents it out. So if you're renting out the home to somebody else, I can't then use my 14 days as a side thing. It's 14 days total for that property. But the other question, Gene, that came up is if I'm renting my home, not renting it out to somebody, but if I rent instead of own, can I use Rule 280A if I'm renting?
Yeah, so bottom line is you are paying somebody else for you to be able to live there. You are a renter. In that case, yes, you can use the Augusta rule so long as you are not subleasing to other people. The tax code does allow for that.
Yeah. We've got lots of questions and we could probably stay here all night. I know when we do these at the 3-day, Gene, you and I give a full hour just to Q&A, and even then we don't get all the questions answered. This audience here with Protect Wealth is so incredible. You know what you're talking about, and I wish we could answer and unpack every question, but we can't. But because of that, we want to give you this free whiteboard session to have a consultation with a member of our team. Go to protectwealth.com/tax-hive. The link's in the chat. Scan the QR code. I want everybody, before you go to the next thing that you've got going today, take 30 seconds, schedule that free consult, invest just a little bit of time to help save massive amounts of money from your tax bill. Now's the time to do it. So don't go anywhere else before you do it. Schedule that, protectwealth.com/tax-hive. Kendall, thanks for having us.
You guys, thank you so much for your time. I know we have a short amount of time tonight, but Gene, Chris, thank you very, very much for the generous offer. You guys, we love TaxHive because they genuinely know what they're talking about. Obviously, you can tell that Chris and Gene have a tremendous experience. They're not just your average tax preparer. You know, as tax planning, it makes a big difference. And Chris and Gene, you guys know the biggest thing for me personally, takeaway, I'm sure a lot of you get this, it's finding ways to save money. And then if you compound that, imagine, you know, it's the 8th wonder of the world, compounding that money savings and investing it, putting it into other things. Just you'll be so much further ahead of the game. So, guys, thank you so much for the information.
Thanks, Kendall,
Pleasure.
for having us. We look forward to talking to all of you. We look forward to spending time together. So thanks for having us, and thanks to everybody for joining us here tonight.
Thank you for being on it, guys. We really appreciate the expertise again. And make sure everyone on the call, please make sure you do go to protectwealth.com/taxhive and sign up. They really do have a good bunch of people there to help you answer questions, go through a free consult. And really, Chris, it's free, right? So really, it's free. You have nothing to lose. If you don't have a tax preparer, even if you do, you may as well do the consult because it's free and you might find some money you didn't have before.
There's no risk. And to that point, Kendall, I mean, so often, well, let me be super candid here. I'll be super candid. Our goal is to do such a great job on your tax planning that you want to use us long-term for your preparer too. I mentioned we have both divisions, but we do work with people that their sister does their taxes and they can't leave her. And we can still tax plan and advise, and then she can still do your taxes. So regardless of where you sit, if you're part of that 75% that doesn't believe you're maximizing your return, come talk. Let's have a conversation. Certainly I'll be transparent. I want to earn your business long term, but even if we don't, let's put you on the right track. Let's get you your planning in place, and you can keep using your current preparer if that's what you choose to do.
Yeah, maybe you really impress your sister, your tax preparer. They make me really, really impressed. See? That's the
Amen.
idea, guys. I love it. Thank you
Thanks,
so much,
Kendall.
guys,
Thanks,
again for
Gene.
being on. We appreciate it so much. Everybody else, look forward to seeing you again. Thanks for coming to the webinar and take your time to be here. Have a great night.
Thank you.
Thanks, guys.